Welcome to Fundoo Money, your 24/7 buddy on all matters related to personal finance. In this particular web series, we are discussing various things you need to keep in mind while investing in stocks. In this particular segment, we'll try to decode an oft-used term, that is debt-equity ratio. That's coming up shortly. Debt-equity ratio. What on earth is debt-equity ratio? What is it all about? Why should an investor be worried about this term that keeps coming up in newspapers, television programs, and what have you? To help us out, we have got stock market expert Mohit Satyanand. Hi, Mohit. Mohit, debt-equity ratio. It's so much used, and it's words like that can throw off a lay person. What does it say, and what is it all about, and what should a lay investor be looking at when the word debt equity ratio is coming?
Yeah, this is a tricky one because companies do need to borrow money in order to grow, typically, except for consumer goods companies. Companies in certain sectors need to borrow much more, and therefore traditionally we've grown comfortable with infrastructure companies, for example, having much higher debt equity ratios. But I think at the end of the day, what's really important is to figure out whether the earnings of a company are large enough for them to service their debt. Because when you borrow money, you have to pay a certain amount out by way of interest every year. Unlike equity, where you only pay shareholders if you actually make a profit. In the case of debt, banks are by and large not forgiving. That money has got to be paid out every quarter. And these are obviously things that companies think about or should be thinking about before they borrow that money. And therefore it should be built into their finances. But again, I think it's, ratios like these are much more interesting in a dynamic sense than in a static sense, which is that if you look at a company with a fairly high debt equity ratio, let's say I know it's arbitrary, but let's say any company which has a debt equity ratio of more than 2:1, then I think before investing in that company, you need to do a fair amount of research. You need to look at how that debt has moved over time. You need to look at whether the cost of finance as a ratio of the gross profit of the company has been going down or going up. Mm-hmm. If it starts going up, then it's likely to continue to go up for a long time, and you're probably better off just exiting at that point in time. So again, it's not the number, it's not the debt equity number itself, but just the fact that when the debt equity number is a little high, you need to make sure that the company has figured it out, that it's managing that debt well, that it's making enough gross profit to service it. In itself, debt is not bad. As long as you figure it out in terms of your overall cost engineering of the company, and you're able to service that debt and still have enough profit left over to pay shareholders.
Why is it being benchmarked to equity? What is the reason for that? Is it because you're the owner, you need to know for every unit that you own?
Yeah, it's the same as
earnings.
It's the same as, for example, my EMI.
Okay.
Right? Mm-hmm. So is an EMI of 50,000 rupees large or small? As an absolute number, it means nothing. Mm-hmm. If my annual income is 2 lakhs of rupees, then a monthly EMI of 50,000 rupees is clearly unserviceable. Mm-hmm. If my annual income is 50 lakhs, then an annual EMI of 5 lakhs is not so unserviceable. So, equity is like that. That if the company has a huge equity base, then debt is, it can service a lot more debt.
Mhm. Well, that sounds fascinating. I'm sure other people who are listening to this or watching this would find it interesting. They might have a different perspective. Please feel free to share with us your perspective. Go down to the comment section, plug in your comments, give your suggestions. If you like this video, click on the like button. Of course, we'll love to have you as one of our subscribers. Please click on the subscribe button. And apart from that, and last but not the least, please stay connected with us on all leading social media platforms.